You said it early. This is something that never happened in the history of mankind. You can compare this virus to different viruses, but we've never seen anything where we shut down, and it's not 50 million people, it's 500 million people in China, if you count all provinces, right? Because there was only about 7 or 8 that were really impacted during SARS, 2002, 2003. Every single one of them, all 31, were impacted this time around. So they were looking at numbers and saying, okay, based on SARS, it was 9 months, and we're going to see a real V-shaped recovery. And that's when I was like, these guys, I didn't feel like they understood that you're not just going to open up a door and 500 million people are going to go back to work.
Okay, friends, thank you so much for tuning in. I'm really glad you all are here to hear this one because I think it's very, very important, especially given what's happened to the U.S. stock markets over the past week. I have on the line right now Frank Curzio. His website is curzioresearch.com, and you can find him on Twitter at Frank Curzio. And I'm going to quote one of his tweets from about a week and a half ago in a second, but first, let's welcome him. How are you, Frank?
Thanks so much. I really enjoy it. Listen to you guys. So this is really, really cool. I really appreciate you asking me to come on.
Well, it's my pleasure. I'm glad you came on because this past week, we saw something that we probably have really never seen in the stock markets before, which is the most rapid, precipitous fall in the NASDAQ, the Dow, and the S&P that we've ever seen, meaning it's fallen faster, at least in point terms, than it ever has in such a short period of time. And I want to let people know here, I'll quote you via Twitter. On February 21st, guys, before this precipitous fall began, Frank wrote, "The coronavirus is a bigger problem than the mainstream media is saying. I put together weeks worth of research into a special report. Every investor needs to check it out and make sure their portfolio is protected." Now, guys, had you gone short these markets on the 21st or the 22nd, you would have made a ton of money. And Frank, I don't know that it's going to get any better before it gets worse. Your thoughts?
I think it's going to get worse before it gets better. Yeah, I think you nailed it there. The first thing I think we need to address is there's a difference between a health crisis and there's a difference between an economic crisis. This is an economic crisis, not a health crisis. So what I mean by that is it's going to spread in America, okay? And I've been saying that ever since the president went on, the CDC went on. There's only 50 cases in the U.S., and they're like, just warning us. So they're warning us because they haven't tested for it. So you're going to see it spread, and I think there's a lot of fear out there. Wow, it's coronavirus. I'm going to get quarantined. It's a little bit worse than the flu. Okay, so from the health perspective, I don't want people to run out and think they're going to lock themselves in their houses because it's kind of like the flu where we're not closing Disney parks, we're not closing anything. Some people are going to get it, and then you have to ride it out because there's no vaccine or anything like that. But as from the economic perspective, what I saw early on, this is about the first week of February, I just couldn't believe where the markets were trading when you had China disclosing coronavirus. The contacts that I've had in China were telling me how it was spreading. They had no control over it. Then you saw the death rates coming in. And then we also saw companies warning. This is like mid-February before the market crashed. Companies, there's probably 25% of the S&P 500 companies were actually saying, we're concerned about the coronavirus. It's definitely a concern. It's definitely a concern. And we were trading at an all-time high multiple of 19 times forward earnings. To put that in perspective, the last 10 years, the average multiple is 15 and a half. So at 19 times, that means we're trading in a huge growth market, right? So that's okay because we were in a growth market. Earnings were growing. We had favorable policies. We had low interest rates. Earnings were growing double digits. It deserved it. I've been bullish for a while. But when you take China out of the equation, and one of the stats I haven't seen mentioned a lot is China accounted for 40% of the economic global growth, right? So the global growth, they account for 40%. That's according to the IMF in 2019. And now it was completely shut off. So we're trading at a growth multiple. When the growth avenue is shut off, it was just a matter of time before these stocks came down and came down hard. So we were actually predicting, and I haven't had too many people say this, but we were pretty early on saying this could lead to a global crisis. It was a call I wish I was wrong on because the fact that you're right, more people are going to die. And I think there's some things that are more important than money, to be honest with you, Sean. But I still think we're in the very early innings here. We really are.
I've said before, I've used this quote a lot. It's not mine, but men lose their minds in herds and come back to their senses one by one. And what occurs to me about this whole coronavirus pandemic is that the market ignored it when the evidence coming out of Wuhan was so shocking and alarming, given the draconian measures being implemented by Chinese officials. That went ignored when everybody should have woken up, including myself, to go short NASDAQ, Dow, and S&P with maybe leveraged ETFs. Is when they locked down Beijing and when we were hearing that Foxconn was shut down, the Apple factory. It's amazing to me that it took so long for this thing to start to unwind. It all started to hit this past Monday, just a week ago, Frank. The news was right there for us all to see. The tea leaves were right there in the wide open, and it went ignored for at least a week too long.
If you did a little research on it too, Foxconn has two major plants where they supply, I think, 46 million iPhones, and they was shut down. I think some people wanted the impression, and this is where I think, I'm a Wall Street guy, right? So, I've been through 25 years of this, and I have a lot of friends that are sell-side analysts that are good. I'm not picking on them. But when it comes to sell-side analysts, and which is sell-side means just institutions, guys, JP Morgan, Goldman Sachs, those who present the earnings that you see in the bottom of the screen, it's their consensus earnings. And when they analyze things, they take historical analysis, based on history, what's happened, and then they create discounted cash flow models and tell you what's going to happen in the future. They were looking, when they look back at history, because that's what you want to compare it to another market, just like Ben Bernanke compared the 1930 depression and what we need to do for, the credit crisis, in 2008. And I don't know, when I saw the analysis, they were comparing it to SARS. And I thought that was a disaster. SARS was in 2002, 2003. China accounted for just 4% of the economy. Okay. Now it accounts for 17% of the economy. Okay. When I talk about the global growth, I'm talking about just the economy itself, 17% of the economy. There was 16 million people traveling back then in China. There's over 160 million traveling now. China is a major, major component now. And you're comparing it to SARS, which was a 9-month process, which was only, you had 8,000 infected. And we're well over 80,000. Even when we were 2730, it was so quick that it happened in just like a month or two. They were comparing it to something when you said it earlier. This is something that never happened in the history of mankind. You can compare this virus to different viruses, but we've never seen anything where we shut down, and it's not 50 million people. It's 500 million people in China, if you count all provinces, right? Because there was only about 7 or 8 that were really impacted during SARS, 2002, 2003. Every single one of them, all 31, were impacted this time around. So they were looking at numbers and saying, okay, based on SARS, it was 9 months, and we're going to see a real V-shaped recovery. And that's when I was like, these guys, I didn't feel like they understood that you're not just going to open up a door and 500 million people are going to go back to work. People, they have kids. In China, I don't know if you've been to China. I've been there. A lot of people travel hundreds and hundreds of miles to work, and then they stay at these places for 3 months, and they shut down all travel. So the time you get these supply chains back online, it was just going to take, it's at least a 6-month problem. I thought it's going to be a 9-month problem. And now I think we're realizing that, where it's not just one quarter, hey, okay, this is bad, it's going to come right back. It's going to take time. It's going to take several quarters. And that means no earnings growth this year. And that's a really big deal. So, that's why you're seeing stocks come down a lot. It's going to come down a lot more. And, if you want, I'll break down the numbers for you in the easiest possible way. But I'm sure after I'm done, you're going to understand why we have probably at least 15% more downside from here.
That's exactly what I was just going to ask you. I think this past Thursday, I saw a tweet from you. The Dow at this point was down, I think, 10, 11% in short order in just a few days. And I think I read a tweet from you saying we could go down another 20% from here. And people need to understand the stock markets are forward-looking. You're paying multiples higher than earnings to own a stock because you believe profits will be coming in the future. What does this mean to companies like Apple? How about Walmart and Target, whose shelves are stocked with things made in China? Let's talk about where this thing goes, because I think we both think it's going to get far worse, especially if it becomes a pandemic in this country. Then all bets are off. Then stocks could go down 50%.
Yeah, I mean, I'm not there at the 50% level yet, but I will say this, and I'm not someone who's looking for headlines or is panicky. I'm probably the least paranoid person you'll ever meet, which my wife gives me a little crap on sometimes. But it's just numbers, it's not emotions. And when you look at the market trading at 19 times forward earnings, it shouldn't be trading 19 times forward earnings unless earnings are growing. Goldman Sachs just came out and said 2020 estimates are going to be flat. They were late to the party. They thought this was going to be one quarter, but I credit them because they changed their mind. When the facts change, you need to change. So when you're looking at those types of earnings, and by the way, I think that's not aggressive enough. So they're being too conservative. So they're not just talking about next quarter. They're talking about all 2020, no earnings growth. So let's explain what that means, because we were trading at 19 times forward earnings. And we should be trading more around 15 times an average, kind of like a value market multiple, even a little bit lower than that. So stocks have come down, right? So we have, a 14% sell-off as of today. Now, I think what's getting lost here is when you take the combined earnings of the S&P 500, in 2019, it was 159. I'm not going to throw too many numbers at you here, but it's important to understand this. They were expecting $181, which is 14% earnings growth in 2020. Now, if you take Goldman saying there's going to be no earnings growth, that means it's going to be $159 again. When we're looking at 19 times forward earnings, everybody's taking that $181. That hasn't been updated yet because sell-side analysts need numbers, and these guys, Apple just removed their guidance. They didn't say, well, we're not going to earn 60 billion this quarter, it might be 55. They said, we have no idea. So they don't know how to model. So the point is, we were trading at 19 times forward earnings before this happened. We're still trading at 19 times forward earnings because the stock market has come down, but also earnings have come down. That's why when the market went higher and you're like, wow, we're expensive. We really weren't expensive. We were trading at 17, 18 times the whole time because earnings were going higher along with the market. Now it's the opposite. So you can't take the 181 number. If you're looking at forward earnings and really believe that we're not going to have earnings growth, we should not be trading at 19 times forward earnings right now because that's what we're trading at, around 18, 19 times, even after the sell-off, because earnings, again, we're projecting, I think they're going to be even less than 159. So, I would say from where we are now to 15 times is around 15, 20% correction. But with that said, we could throw a wrinkle in that. Look at what happened in the credit crisis. When the government came out, there's going to be a coordinated effort, lower rates, backstop industries. The only problem is this isn't the credit crisis, okay? You're looking at this more as a supply problem. And yes, it's a supply problem, but supply is going to come back online. We don't know when. It could take 6 months. It could take 9 months. It could take a year, but it'll come back online. This is a demand problem. You're not going to, lower rates are not going to get people to come out of their houses to go spend. So I'm not too sure if that measure is going to be good. You're going to see the market pop on that news, but I just think it's going to take a lot longer. So, I'm not under the impression that, listen, we're going to see a 50% market correction. We could go down another 15, 20% from here. We're going to see more stimulus. But remember, once we get a hold of this coronavirus, and we will get a hold of it eventually, it's not going to be around forever. I'll throw a date out there. It's going to be June, I think, because if you look, the coronavirus is basically part of it's part of flu, it's part of the swine flu, it's part of SARS. Again, it's all in the coronaviruses. And all these viruses usually die off. They're seasonal, right? You don't get the flu during the summer because it can't really be transferred in the summer, right? It's transferred when in cold weather. And as it gets warmer, you're going to see a lot of these cases go down, down, down. You're going to see more and more people get it, maybe even your neighbors, and it's going to be scary at first, but it's really like getting a bad case of the flu. And I think once you go through that period, and again, we'll probably see numbers coming down in June. I'm not saying to go buy the market, but you'll probably see some opportunities where, hey, you know what, you could get back in there and buy a couple of things, July, as you're seeing the numbers improve. But, don't be a hero here. Don't jump in front of a train. Just because you sell it doesn't mean you're panicking. I mean, how many times have we heard that on TV? Well, you're panicking. You shouldn't panic. I heard that for the last 4 days, and you could have saved 3,200 points on the Dow. It's not panicking. It's being smart. I mean, bear markets are good if you're prepared, right? Because you're going to have money on the sideline. You're going to be able to buy assets cheap, and that's what you want to do. So, we were fortunate to get a lot of our stocks. We did very, very well over the years. I'm sure everybody did well with the S&P 500 going higher. They took a lot of that off the table. We told them to, and we're getting a lot of thank yous right now. But now we're in a position to just sit back and wait for the market to come to us, and we're going to be able to get a lot of bargains. I don't know if that's going to be 3 months. I think it's more going to be 6 to 9 months, but we're going to have a lot more pain coming. I could definitely tell you that.
Okay. Well, I like your perspective on this thing sort of blowing over by June. One of the fears I have, and you can stick this in your back pocket, is Francis Boyle and other researchers are saying that this thing is a bioweapon. It is much, much, much more dangerous and virulent than pneumonia or SARS or anything that we've seen previously. So this may go on for quite a long time because of the nature of it having been made in a lab and released. We don't know if it was on purpose or by accident. But you said don't panic, but at the same time, who wants to lose another 20%? Is the best place to be cash? And in lieu of cash, what are some other great investments? Do you have any stock picks? I mean, gold on this past Friday, by the way, dumped $50. I mean, give me a break. That's absolute lunacy. Hello, manipulation. What do you recommend?
I think cash for now is definitely good. You should be in cash. That's where our clients are in right now. So you should definitely be in cash, our subscribers. And you should have a little exposure to the market because, look, we could be wrong, Sean, right? You got to throw in that fact where I've I'm fortunate to have a very wide net out there because we're early to this, and we have a podcast called Wall Street Unplugged where I'm getting emails from all over the world. It gets downloaded like 100,000 times a month. So I have a really good net out there, good pulse in the market, and I've been doing this 25 years. I've been fortunate to have a really good Rolodex. So that includes leading infectious doctors and things like that. From what I'm hearing, there's even from the FDA part with their specialists, which I read today, they don't see any kind of vaccine coming for at least 3 months. And if it does, it's going to take another month or two to actually process. So, this isn't going to go away anytime soon. I mean, you could say 6 months is not soon when the market's dropping the way it's dropping, right? I mean, it's pretty crazy if you think this can go on 6 months because we're in a different market, John, than we've been, post-credit crisis, where everything happens so quick, right? I mean, markets crash right away, they go back up right away. It's, everything happens so quick. You don't have like, the 90s where it's long drawn out. We're in 2000, 2003 or 4 after the tech bubble where you have 4 years. It's usually like a massive, like we're seeing right now, the quickest ever fall, like you said, from the highs. If this goes on for 6 months and we're seeing this, we could go down tremendously. But, I just don't see this being that much of a short-term problem of less than 6 months. And that means if I'm right, even, when I said June, I think we're going to see the numbers come down. That's no way going to stop it. It's not like, okay, June, we're seeing the numbers come down, everyone's going to go to work and, supply chains are back online. No, that's going to take months and months and almost a year to develop. So this could go into 2021. And again, I'm going to probably piss off a couple of people here, but you have to look at the election. And we have Bernie Sanders winning, he's leading the Democratic nomination right now, and Trump is kind of like, oh, the economy's great, there's no way you'll unseat him. Well, if the economy's not good and you're seeing this market fall down, and he's made some mistakes, no doubt, and again, take politics aside, warning us about the coronavirus, if he gets elected in the U.S., look out. I mean, he's going to end all fracking. He's going to increase taxes dramatically. He's going to take money and give it to the poor, which is something that's never worked in history. I mean, if you don't have a job, he's the best candidate in the world, and you don't make money because he's going to relieve your debt, give you free health care, has no idea how he's going to pay for it, but it's really scary. This wasn't on the table before this. In the last 3 weeks, this is starting to be factored into the market where if this goes into October, and we're still down a lot and it looks like it's going to get worse, it's going to be a scary scenario. And I'm telling you, a lot of people, a lot of big fund managers I talk to, very, very big money, $1 billion funds, they're going to position themselves and they're worried, and they should be. I mean, that could happen. I mean, so that's something else that's on the table that maybe a lot of people aren't really talking about.
Yeah, well, one of the things that's concerning, we have Mulvaney warning that coronavirus could lead to school closures. And of course, blaming the press for peddling the false narrative to take down Trump. Yeah, as though Trump could have done much of anything to prevent this thing from coming here to our shores. By the way, let me ask you, circling back to China, talk about having all your eggs in one basket. We as a nation rely on China too much. Apple's supply chain. Get this, Apple losing 2 key operations and supply chain execs at an unfortunate time, according to 9 to 5 Mac. Yeah, I think they were probably let out the door because they were in charge of supply chain and they didn't have any backup plan. It's just amazing that a company like Apple would have all their eggs in one basket.
Yeah, and it goes to show you about China because you can't forget about the trade war because there's a lot of companies, and I follow this directly. A lot of companies due to the trade war were already moving their supply chains out of China because they couldn't deal with the uncertainty of, Trump tweet and we're going to raise taxes, we're going to raise tariffs by this much. So we can't deal with that uncertainty. It's too hard to forecast. So we said, let's lower that risk and move it out to Taiwan. Let's move it out to Vietnam, wherever. And you already saw that. And that was before the Hong Kong protests, right? And now you have a Hong Kong protest, and then you throw this on top of that. I mean, to me, I think China's a dead they're going to support as much as they can. They're going to throw so much money at it. But, one thing I will say, there's a lot of conspiracy theorists out there. I mean, you could just Google it and you'll find millions of them. But China did not want to solve this problem. They didn't want to solve this problem. That's why they didn't let any doctors in there. They got really, really ticked off at us on January 30th when President Trump said we're closing our borders. They ripped us. They were like, "You're crazy. You just take a leap of faith. What are you talking about?" They knew on January 30th how terrible it was already, and they were pissed off at us for closing our borders. And now look at the way we look now, right? That looks like a great, great, great call, but how could China wanted this to spread? I mean, just do the math. I mean, I've been following this this isn't a conspiracy. If you didn't want it, you would have let people are dying in your country and you're not letting the CDC and you're not letting leading doctors from around the world infect you. You're not letting them in. You're saying, no, you can't. Who says that unless you have something to hide? So the fact that this is going around, China's probably maybe one of the quickest to recover because they got it first, but it is, just forget about the numbers, forget about everything, and just use your common sense. I mean, they really could have stopped this a lot earlier. They could have got a lot of help, and they didn't. And they were very mad at countries who were closing their border, even though they knew this is spreading like wildfire throughout the country. That's pretty crazy.
Yeah, well, get this. This is a little inside baseball conspiracy theory stuff. There's a great YouTube channel called The High Wire with Del Bigtree. I'm not sure if you're familiar with that, but Del Bigtree is the producer of the documentary Vaxxed. And Del Bigtree used to be a producer on Dr. Oz and then a show called The Doctors. Very smart guy. He released a video on Thursday titled Coronavirus, the Hidden Danger Revealed. And I would advise everybody to go listen to that because it's really shocking information. I had no idea. Apparently, on December 1st in China, they rolled out mandatory SARS vaccinations. I didn't know about this. And he goes into detail about that. He breaks down the timeline. He breaks down the dangers of a SARS vaccine. And he basically makes the argument or proposes the thesis that these deaths are the result of a SARS vaccine gone wrong. And that's why China wanted to cover it all up. So,
I mean, the original stories, it came from like a seafood market. And again, it is from bats and, coronavirus. They closed down a seafood market, but now we're like, even the doctors who died, the doctors who tried to warn them and say, hey, this is, they just didn't care. And a lot of those doctors are dead because they didn't even look and say, okay, let us help you or anything. It's really, you have to remember something too, right? I think when I have a great contact, a fantastic contact, right? And he's, level-headed. He's giving me amazing information. And he's saying, he goes, look, Frank, it's going to sound a little crazy. He goes, but, it's in the best interest for China to actually continue to have this going on and on. Why? Because they have an aging population, right? They don't have a lot of young population because, they have a 2-child policy in there. And I'm like, at first I'm like, wow, that's crazy. That's far-fetched. And then he went on to say, he goes, look, you have to put yourself in China. In America, in Canada, we don't think like that, right? It's free, it's a dictatorship. It's communism. It's the government needs to control everything. And what's the best way to do this? How do you eliminate, your elderly population? How do you stimulate the economy? This is one way to do it. Does it sound crazy? I think it's a little crazy, but you know what? Who knows? It's just every time, the more I research this, and trying to be honest with you, you're going to be hard pressed to find anyone that's researched the subject more. I've just been engulfed in this thing for the past 2 months, 3 months. China just wanted this to happen. I mean, it's just, it's sad. Otherwise they'd ask for help. They would ask for people to come in to help them to stop the spread. They wouldn't have got mad at other countries for closing their borders when they knew this was spreading rapidly. It sounds like they wanted it to spread. So it's really sad. And, again, we'll never know about that. And I don't know if that matters now. It's a good story, but this is about your portfolios. And right now, the rest of the world's catching it. And it's going to lead to global disruption and a global recession. That's something that we called 3 weeks ago when the markets were at all-time highs. And it's crazy. I didn't think it happened this fast. I really didn't. And it is happening fast. And you have to be a little bit worried here.
Yeah. Well, as a stock picker, I guess maybe we should ask your thoughts on a few things because obviously people will be looking eventually for bargains in names like Apple and, any of the other big tech stocks, I suppose. But like I said earlier in the interview, at this point, at least this past Friday, gold wasn't even a safe haven.
Not on Friday, but it was a safe haven leading up to this, other than the past 2-3 trading days, which was a surprise that it went down so much. I remember that there's still a lot of people in there that maybe have a bad taste in their mouth where it's been such a bad market. And what do you need if you want to sell? You need extreme high liquidity, and everybody was saying to buy gold at the same time, which caused huge liquidity in the market. So you might just have a bunch of people going out there selling. I wouldn't dismiss gold as not being a safe haven. I wouldn't put all your money in there, but just be a little careful because we've seen the whipsaws right now. I'm very surprised that it came down that much as well. But, there's a lot of names in there that are definitely worth buying. And there's going to be more and more money going into gold because there's just a lot of uncertainty. You're going to have China, even China's buying gold right now. You're seeing a lot of buying gold. Again, this was like a 2-day sell-off. I'm not there yet, Sean, saying that, gold's not a safe haven after a 2-day, 2.5 day sell-off. I think I am using that as a buying opportunity to add to a few of my gold holdings right now.
Like what? Because, the mining shares have been beaten to hell.
They have been. They have been. But remember, if you're looking at a lot of the royalty companies and you're looking at the majors, I mean, they've made some incredible moves, right, over the past 12 months. So, they've given up some of those gains, but still they're up tremendously. For me, I'm looking for juniors that haven't participated and those that have great assets. GoldMining is one of those companies, Amir Adnani. They have tons of projects. They've just been buying gold like crazy since 2011. And now they stockpiled all these, you're just sitting on a nice asset base of gold where gold prices, it made sense at 12, 1300, at 1600 still, all around there. I think gold's going to go to 2000, to be honest with you. I just don't think that, again, that 2-day sell-off is really an indication that it's not a safe haven. I just think it's more like a trading thing. When I look, go ahead.
Sorry, I didn't mean to interrupt. I want to get Amir back on too, by the way. I should do that. What do you think of like GDXJ, like a basket too? Do you look at those types of things? You wait for a bottom and then you buy in on these baskets?
I wouldn't buy that. No, I wouldn't buy it. Listen, if you're an outside investor that doesn't follow markets, buy that, right? It's like me. This is what I live and breathe. Sean, you live and breathe this, so we know the good names from the bad names, and a lot of those names get lumped in. So for me, over my career, I've been able to outperform S&P 500, but you would have been okay buying the S&P 500. So I'm not saying that that's not a buy. I just think if you look at individual names, and here's the key which I would look at, is look at names in the junior market space that haven't participated in the run higher over the past 9 months or so, that have the highest cost of production, or the highest cost if those mines would come to production. And you might say, well, that's crazy, but you have to realize if you're looking at the majors, are all in costs of whatever, $800, $900. So their margins are incredible, right? At 13, 14, 15, 16. There's a whole bunch of projects that were just completely off the radar at 1,300, 1,200. Like you look at kind of like McEwen Mining, got tons of problems, right? I mean, they just delayed some to their biggest projects, but here's a company where it's like 1,200, 1,250, and you just, in our world, it's weird, right? It sounds crazy, but when you have a company that goes from uneconomical to economical and making profits, the move in the stock price is probably 5x that of a major. The major's been generating profits, and if gold keeps going up, they're going to continue to do that. Some of them pay dividends now. That's how, they're in great shape now compared to, 3, 4, 5 years ago. But McEwen Mining is one that I like, that it's gotten total beat up. Those costs are going to come down. But now you went from, wow, this company, is it even worth anything, right? We're at 1,200, 1,100 now at 1,600. If you really believe prices are going to go higher, try to find the companies that have, costs of 1,200, 1,300 if those mines will get developed, because now they're back in play and those things have gotten killed and haven't participated in the move up. And that's an easy way to really make a lot of money if gold prices go high, which I think they will.
Okay, interesting.
Threw a lot at you there.
Yeah, well, it's a lot to take in because in this environment, it's just obviously so scary because the point I made in a recent video I released is that even if you don't have stock market positions at all, this thing could eventually affect you because if it gets bad enough, your employer might not be able to pay you. That's a worst case scenario, but I mean, that's pretty much what we're seeing in China. So as we round out this conversation, let's just end with coronavirus because that is the market mover one way or the other. Now, over the weekend, we saw panic buying at places like Costco. At stores across the country, Zero Hedge notes, the panic coronavirus hoarding begins. Meanwhile, coronavirus has reached community spread within the United States, according to Dr. Anthony Fauci. And unfortunately, Alameda County declares state of emergency after medics test positive for coronavirus, and the global virus death number, at least the official one, is over 3,000. So this thing is accelerating fast. And now, Frank, the big question is, will central banks, along with the Fed, do a coordinated bailout? But to your point, Frank, flooding this system with more fiat dollars is probably not going to be the fix they hope it is.
It's not going to fix it, but what they're trying to do is fix sentiment. That's what they tried to do last time. They actually, people forget this, but in the U.S., they gave people money because I bought my house in 2010, fortunate to buy it at the low, not because I'm a genius or anything. That's when, we're looking for our first house with my wife and family. And the government gave us a check for $8,000 to buy the house. They were giving you thousands of dollars to buy cars, right? So they were encouraging. Why were they doing that? They were backstopping everything and saying, it's okay, go out there and spend because it's a spending economy. If you don't spend, that's what's going to crush the markets. They're trying to flood the markets. And what's bad about this time, Sean, I said this after the credit crisis, the worst thing that ever happened during the credit crisis is that the government made a freaking fortune. They made a fortune by bailing everybody out. And that was terrible because if you look at Fannie and Freddie, they're still in conservatorship. They didn't know. They thought they were just going to be zombies. And they're making billions of dollars because they basically took every single loan on their books in the housing market. When the housing market recovered, it took off. AIG, they made money on the car companies. The banks, they made a fortune on all those warrants. That was the worst thing that could have happened. You know why? Because this time around, what do you think they're going to do? And if you think the market's going to completely crash, you have to keep that on the table because they may get, and I'll use the word stupid because they just might flood the markets and do that again. And get, if we're going to continue to go down, again, they're influenced by Trump. Trump's barometer of the economy is the S&P 500. And if that continues to come down, there's going to be, lower taxes. There's going to be incentives to buy everything. And that may, again, long term, as well as I do, it's going to be terrible, but short term, that may prop up the markets, but I just don't see it. But as an analyst, you have to throw that out there because the government's definitely coming in and it's going to be a global coordinated effort.
Yeah. All right. Final thing here I want to cover is just how bad it could get here. And we will quote you from Twitter because, again, this isn't fear mongering. In a recent video I posted, I saw a lot of comments below it when I was giving a brief coronavirus update, a lot of comments saying this is fear-mongering by the elite, they mean, not by me, but this is fear-mongering. It's all a psyop designed to implode the economy so Trump doesn't get reelected. I understand that perspective, but at the same time, we have to be pragmatic. What's going on in Wuhan is not a psyop, in my opinion. I think real people are dying in droves, and it's very scary. And you wrote just the other day, wouldn't be surprised if the U.S. ends up having more people infected with the coronavirus than China.
Yes.
That's a scary thought. Why do you think that could even be possible?
Because we haven't been testing for it. We haven't tested for it at all. We haven't tested for it. So right now we're not testing for it. Our tests, you know what our tests are right now? Our test is, if people have a fever, they're going to the doctor, they're being sent home. But if you think you have a coronavirus, they'll take the test and it's 48 hours to actually get it back. To see, you have to send it to the CDC, they have to send it back. It's got to be an immediate test. We don't even have those. So again, common sense. If it's spread in Iran, you got to be crazy to think it's not going to be spreading, and Italy as well, that's not going to be spreading in the United States, right? I mean, it's absolutely crazy. I mean, with the travel and everything, but there's stories coming up. I'm at Pulse on the Market in the U.S. where there's a lot of people detained right now that number is going to go higher. Again, I'm trying to tell my clients, it's not a health crisis where, oh my God, I can get this and I could die. You're not going to die. It's going to be around 1% fatality. Anyone that has a good healthcare system is around 1%. It's a little bit worse than the flu. I know you said one of the people said that you quoted said it's worse than pneumonia. It's not worse than pneumonia from everything that I covered. It's not. So it is if you're in China and they don't do anything for 3 weeks and, a lot of people are going to die. But, if you're able to get fluids or something like that, we have a good healthcare system. It's terrible monetarily wise. But, I mean, you could get to a doctor pretty much within 5 minutes almost anywhere you are in major cities in the United States. So, as long as you're taking care of yourself, it is going to spread. You got to just look at it as more like the flu. And unfortunately, if we did, that would be better for the economy because people wouldn't be scared. But with the media coming out and all these stories, and they're going to just go crazy saying how bad it is, you got to stay in your house, you got to lock in, you're going to be on quarantine. That scares the hell out of people. If you're saying you're going to be in quarantine for 2 weeks, that scares the hell out of you. So, I'm not, it's the health part, I'm not scared at all about but I do think it's going to spread. It's going to spread a lot in the U.S. And that's why they've been preparing us for it. I mean, again, the president took out, space at 6 p.m. to tell us when we have 50 cases that, oh, it's okay, we got to why are you even mentioning it unless something's worse than expected? So you're going to see these cases really go crazy, I think, over here. And like you do with the flu, it's going to be similar to that, a little bit worse. And that's going to scare people. And I don't think that's really factored into stocks, which is why I still think we got a long way to go here before everything's okay.
All right. All right. Well, not the best news in the world, but at the same time, we have to cover these topics because they're real world topics. This is affecting people around the globe, and now it's starting to affect us given the plunge in the stock market. So our guest has been Frank Curzio. You guys can follow him on Twitter at Frank Curzio. Also, you can check out CurzioResearch.com and the podcast, Wall Street Unplugged. How do they find that?
Thanks. They can just go to iTunes, put Curzio in it. I've been doing a podcast, believe it or not, for 12 years, right? Before anyone knew what a podcast was. Now everybody has a podcast, which is awesome. And I love to see that, in the space, how many people are coming in, because it really gives a voice to a lot of people. We've been doing it for a long time. We're really proud of it. Never missed a week. And it's so you can find Wall Street Unplugged, and you can find more information too on, we have a special free report, guys. It's not charging anything on our website too, just to help you guys out, because we want to make sure your portfolio is positioned right.
All right. Very good. Frank, I really appreciate your time. Thanks for coming on.
Thanks so much for the interview, man, Sean. I appreciate it.
Yeah, my pleasure. All right, guys. Thank you so much for tuning in. We really appreciate you as well. And remember, guys, for real news 24/7, you can visit us directly at sgtreport.com, the antidote to corporate propaganda. God bless, guys. Have a great week ahead. Bye-bye.
But we know that we're living on a planet that has evil, and right now they're all going crazy with the evil. So let's just get ourselves in shape. We don't have to worry about retroviruses or heavy metals or anything else they want to throw at us. Have at you, because we're going to be strong.